Welcome to our deep dive, into the world of real estate investing. And we're tailoring this specifically for you. We know you're looking for advice, that practical advice, and those quick estimation tricks that'll help you get started off on the right foot. Before we get into all of that, though, I thought it'd be fun to choose a name for this deep dive together. I was thinking something catchy, something like Brick and Mortar Basics, or The Property Primer, maybe Rookie Returns. I don't know, that kind of has a nice ring to it. We'll let you decide, though. Head over to our website or social media to vote for your favorite, and we'll announce the winner later in this deep dive. Now, I'm so excited to introduce you to our real estate expert, who has this incredible knack for making even the most complex concepts so clear and accessible, especially for beginners like yourself.
It's great to be here. Really excited to help guide you through this exciting world, real estate investment.
Real estate investing can seem really daunting, though, especially when you're first starting out. I always think of it like standing at the foot of this mountain and just wondering how you're ever going to reach the summit. I was thinking, maybe we can use a metaphor to make it feel a little less overwhelming. Right. Like imagine it's a game, like a strategic game where you learn the rules and build your skills and level up as you progress. What do you think about that?
That's a fantastic analogy. Investing in real estate, it does have a lot in common with the game, It requires strategy, it requires careful planning and a bit of risk-taking, but the rewards can be significant, just like conquering that mountain,
Exactly. And speaking of strategy, wouldn't it be helpful to understand why real estate investing is so relevant right now? I know a lot of investors are kind of shifting away from that traditional 60-40 stock bond portfolio.
You're right to point that out. The financial landscape is changing, and real estate is becoming an increasingly attractive option. Especially with inflation and interest rates on the rise, a lot of investors are seeking assets that can offer, stability and a hedge against market volatility.
So it's like finding a safe haven in a really turbulent storm.
Precisely. And we're seeing this trend play out, in a big way. Take Yale University's endowment, for example. They've been increasing their allocation to alternative investments like private real estate for years, recognizing its ability to provide, those steady returns, even when the market is, taking a downturn.
That's fascinating. Yale is known for their savvy investment decisions, so it's reassuring to see them embracing real estate as a key part of their portfolio.
Absolutely. And within private real estate, one sector that's particularly compelling is multifamily. These properties, which include apartment buildings, they provide a consistent stream of income through rent.
So it's about tapping into that essential need for housing. People always need a place to live, regardless of what the market's doing.
Exactly. But let's kind of zoom out for a second and look at the broader benefits of private real estate investing as a whole. First, it can help you diversify your portfolio, reduce your exposure to the ups and downs of the stock market.
It's like spreading your bets across different games instead of putting all your chips on just one table.
Exactly. Second, private real estate offers some unique tax advantages. Depreciation, for instance, allows you to deduct a portion of the property's value every single year, which can significantly reduce your tax burden.
Can you give us an example to illustrate that?
Sure. Let's say you invest in a multifamily property. The IRS allows you to depreciate that property over 27 and a half years, meaning you can deduct a portion of its value every year for 27 and a half years. This lowers your taxable income and ultimately your tax bill.
That's a significant benefit. And it seems like there's even more to it than just the diversification and the tax breaks.
You're right. Private real estate also has the potential for really high returns and consistent payouts. If we look at the historical data from the NCRI Property Index, which tracks the performance of private real estate investments, we see consistent growth over time.
So even if it's not as flashy as some of those high growth stocks, private real estate does have a history of delivering really solid returns.
Exactly. And one more crucial point, private real estate has a really low correlation with other asset classes, like stocks and bonds.
Meaning it doesn't always move in the same direction as the stock market.
That's right.
Yeah.
Look at this correlation coefficient table. It clearly shows how private real estate tends to remain stable, even when stocks and bonds are fluctuating. This makes it a really powerful tool for balancing your portfolio and, weathering economic storms.
It's like having this sturdy anchor. That keeps your portfolio from, drifting too far off course. But let's be realistic for a second. Most beginners aren't ready to just jump into the deep end to become full-time landlords. It sounds like passive investing is a more accessible entry point. What are your thoughts on that?
You're absolutely right. Passive investing allows you to kind of dip your toes in the water without the hands-on demands of managing properties directly. It's like joining a team of experienced adventurers who guide you through the challenges and share the rewards with you.
So instead of tackling that mountain alone, you're part of this, well-equipped expedition.
Exactly. In passive investing, you pool your money with other investors, giving you access to, larger, more diverse properties. And the best part is you're leveraging the expertise of a professional management team. They handle everything from sourcing deals to managing tenants and maximizing returns.
So it's about outsourcing the heavy lifting to those who really know the terrain. Makes sense, especially when you're just starting out.
Precisely. And there are, different types of passive investing options to explore, like funds and REITs, which we can delve into a little bit later. But before we go there, let's talk about, the different strategies you can use when investing in real estate. It's like choosing your character class in our game, each with its own strengths and weaknesses.
Okay, so we've got our trusty team of adventurers, and now we need to decide what kind of quest we're embarking on.
Right. And the first decision you need to make is what level of risk you're comfortable with. In real estate, there are 4 main strategies: core plus value add and opportunistic.
It's like choosing the difficulty level in our game. Let's break those down one by one.
First, we have core investments, which are the safest bet. These are properties that are, already stable and generating income. Think prime locations with high occupancy rates, like a Class A office building in a bustling city center, or a luxury apartment complex in a desirable neighborhood.
So these are the tried and true assets, the ones that have already proven their worth?
Exactly. And because they're considered lower risk, the potential returns are also lower. But they're more predictable. It's like earning a steady stream of gold from a really reliable mine.
Okay, so core is all about stability and consistent income. What about core plus? How is that different?
Core plus adds a bit more excitement to the mix. These investments still involve stable properties, but there's an opportunity to kind of enhance their value and boost returns. Imagine a well-maintained apartment building in a good location, but maybe some units that could be upgraded to increase rent, or an office building that could benefit from some, cosmetic renovations to attract some higher-paying tenants.
So it's like taking a solid foundation and adding some strategic improvements to make it even stronger.
Precisely. Core plus strategies, they fall somewhere between core and value add in terms of risk and potential returns. It's a good option for those who want a bit more upside potential without taking on too much risk.
Got it. A bit more hands-on than core, but not a complete overhaul. Now I'm curious about value add and opportunistic. Those sound a bit more adventurous, like we're leveling up in our real estate investing game.
You're right, they do. Value-add investing is all about finding properties with hidden potential. Those diamonds in the rough, these are often properties that need some work. Maybe updating amenities, improving management, or even, repositioning the property for a different market. Think of it like a fixer-upper, with good bones. You're taking on more risk, but the potential for significant returns is much higher.
So it's like finding a hidden treasure chest and polishing it up to reveal its true value.
Exactly. And then we have opportunistic investing, which is the most adventurous strategy of all. It involves taking on projects with high risk and high complexity, like ground-up development or major renovations. Imagine turning an old factory into trendy lofts, or developing a new shopping center in an up-and-coming neighborhood. The potential for huge returns is there, but so is the risk of things not going as planned.
It's like embarking on this high-stakes quest with the potential for great rewards, but also, significant challenges along the way.
Precisely. Opportunistic investing is not for the faint of heart. It requires a high risk tolerance, significant capital, and a deep understanding of the market.
So it's like choosing the expert level in our game. It's exciting, but you need to be prepared for the challenges.
Exactly. Choosing the right strategy is crucial, and it depends on your individual circumstances. How much risk are you comfortable taking? What is your time horizon? What are your return expectations? Someone closer to retirement with a lower risk tolerance might prefer a core or core plus strategy, while someone younger with a longer time horizon might be more comfortable with value add.
It's like choosing your character class based on your playstyle and your goals. Let's say our listener has a good grasp of the different strategies. How do they figure out how much of their portfolio to allocate to real estate, especially as a beginner?
That's a great question. Portfolio allocation is all about balance. you know? And finding the right mix of assets that align with your financial goals and risk tolerance, it's like assembling your team of adventurers, each with their own, unique skills and strengths.
So it's not just about diving headfirst into real estate.
Yeah.
It's about creating a well-rounded portfolio.
Exactly. We often see that high net worth individuals in groups like Tiger 21, they allocate an average of 26% of their portfolio to private real estate. But that's just a benchmark, not a hard and fast rule.
So it's a good starting point, but not a one-size-fits-all solution.
Right. You have to consider, your own financial situation, your goals, and your risk tolerance. Think about factors like your net worth, your income, your expenses, and how much liquidity you need. Liquidity refers to how easily you can convert an asset into cash. And real estate, particularly private real estate, it's not as liquid as stocks or bonds.
So you need to have enough liquid assets for unexpected expenses or emergencies. It's like making sure you have enough potions and healing items in your inventory before venturing into a dangerous dungeon.
Precisely. And remember, real estate investing is a long-term game. It's like planting a tree and watching it grow over time. While there will be fluctuations in the market, history has shown that over the long run, real estate can weather those storms and deliver solid returns.
That's reassuring to hear. Patience is key when it comes to real estate investing. But before we move on, let's have a quick trivia question to test your knowledge so far. What type of real estate investment strategy involves finding properties with hidden potential and adding value through renovations or repositioning? You have 5 seconds to think about your answer. 5, 4, 3, 2, 1. And the answer is value-add investing. Did you get it right? If you did, give yourself a pat on the back. You're well on your way to becoming a real estate investing pro. Now let's get back to our discussion about passive investing. We've talked about the benefits of having a professional manager handle the details. But with so many options out there, how can our listener choose the right manager? It's like finding the right guild or clan to join in our game.
You're absolutely right. Choosing the right manager is crucial. You're essentially trusting them with your hard-earned money and your investment goals.
It's like choosing a party leader who will guide you through the quest and help you achieve your goals. What are some key qualities to look for in a manager?
First and foremost, look for a manager with a proven track record. How have their previous deals performed? Do their claims match their history? Remember, past performance isn't a guarantee of future success, but it gives you a good idea of their capabilities and experience.
So it's like checking the stats and achievements of a potential party member before inviting them to your group. What else should we be looking for?
Alignment is crucial. How much of their OBUN money are they investing alongside yours? You want a manager who has skin in the game. This shows they believe in their strategy and are motivated to make the investment successful for everyone involved.
So it's like ensuring your party leader is also invested in the success of the quest, not just giving orders from the sidelines.
Exactly. And dig into their team's incentives. Are they rewarded for simply doing transactions or for actual performance? You want a team that's focused on generating returns for you, not just closing deals to earn their fees.
So it's about making sure everyone's working towards the same goal.
Precisely. And find out what makes them stand out from the crowd. What is their competitive advantage? Do they have a unique approach to finding undervalued properties? Are they experts in a specific niche market? Understanding their strengths can help you determine if they align with your investment goals.
It's like choosing a party member who has a special skill that complements the rest of the team.
Exactly. And communication is key in any partnership. So pay attention to how they communicate with their investors. Is their reporting clear, timely, and comprehensive? Do they share both good and bad news openly? A transparent and communicative manager can save you a lot of stress and uncertainty.
So it's like having a party leader who keeps everyone informed about the progress of the quest and any challenges they might face.
Exactly. Now take a close look at the assumptions in their financial model. Are they realistic and well supported? Do they account for potential risks and downturns? A good manager will stress test their models to see how the investment would perform under various scenarios, not just the best case scenario.
So it's about being prepared for the unexpected.
Yeah.
Like making sure you have enough supplies and a backup plan in case things don't go as planned.
Precisely. And don't be afraid to ask about their worst deal and the lessons learned. Every manager has experienced setbacks. What's important is how they handled those situations and what they learned from them. A manager who's open about their mistakes and how they've improved their approach is someone you can trust to navigate challenges effectively.
It's like learning from the mistakes of others so you don't repeat them.
Exactly. To get a real feel for what it's like to work with them, ask for investor references. Can you talk to other investors who have worked with this manager? Hearing firsthand accounts of their experiences can give you valuable insights.
It's like getting reviews from other players who have already played the game. What other key questions should we ask?
Take a look at the company's financial stability. Are they well-funded and likely to be around for the long term? You don't want to partner with a manager who might not be able to weather market fluctuations or economic downturns.
So it's about choosing a stable and reliable partner for the long haul.
Exactly. And finally, it's important to understand their fee structure. Are their fees transparent and reasonable? Do they align with industry standards? While fees shouldn't be the sole deciding factor, they can tell you a lot about the manager's priorities. Ideally, you want a manager whose fees are primarily performance-based, meaning they earn more when you earn more.
So it's about finding a manager who is genuinely invested in your success.
Right. Choosing the right manager is like choosing the right teammates for your real estate investing adventure. Their expertise, guidance, and alignment with your goals can make all the difference in your journey.
That's a great analogy. Finding a manager whose interests are aligned with yours can really make your real estate investing journey smoother and more profitable. It's about building that solid foundation for success. Speaking of foundations, we've talked a lot about choosing a manager, but we haven't delved into the specifics of their fees. Could you break down the different types of fees for our listeners?
Absolutely. Transparency is key when it comes to fees. Generally, you'll encounter two main types: transaction fees and performance fees.
Okay, let's start with transaction fees. What are those exactly?
Transaction fees cover the upfront costs of getting a deal done. Think of them like closing costs when you buy a house. They're usually a percentage of the total investment or the property's value. This would include things like acquisition fees for finding and securing the property, legal and due diligence expenses, and setup costs for establishing the investment entity.
So it's like paying for the tools and equipment you need to start your quest. What about performance fees? How do those work?
Performance fees are a bit more nuanced. They're designed to align the manager's interests with yours. Essentially, the manager only receives a percentage of the profits if the investment performs well and exceeds a certain hurdle rate or preferred return. It's like saying, we only get paid extra if we help you reach your treasure chest.
That seems fair. So both the investor and the manager benefit when the investment is successful.
Precisely. And the way these fees are structured is often referred to as a waterfall. Imagine a series of buckets that fill up as profits come in. The first bucket might represent the preferred return for investors, and only after that bucket is filled does the manager start receiving their performance fees.
That's helpful visual. So it's important to understand how this waterfall works and ensure it's designed in a way that benefits both the investor and the manager.
Absolutely. Always ask potential managers about their fee structure and don't hesitate to clarify anything that seems unclear or unfair.
Now let's shift gears and tackle a topic that's probably on everyone's mind. Risk. Real estate isn't a risk-free investment. How can our listener approach risk assessment in a way that's manageable and doesn't make them want to avoid investing altogether?
Risk is inherent in any investment, but understanding the different types of risk can help you make more informed decisions. It's like equipping yourself with the knowledge and tools to navigate the potential hazards in our real estate investing game.
I like that. So what are the different types of risks we should be prepared for?
First, there's general market risk. This affects all investments regardless of the specific asset. It includes things like economic downturns, interest rate hikes, inflation, or even geopolitical events. It's like a sudden storm that can impact everyone in the game.
So you can't completely avoid market risk,
Yeah.
but you can try to mitigate its impact. How do we do that?
Diversification is key. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes like stocks, bonds, and real estate.
That makes sense. It's like having multiple characters in your party, each with their own strengths and weaknesses.
Exactly. Then there's asset level risk. This refers to risks specific to the type of property you're investing in. For example, office buildings might be more vulnerable during economic downturns than multifamily properties because businesses tend to downsize while people still need a place to live.
So it's about understanding the strengths and weaknesses of each type of property and choosing your investments strategically. What other risks should we be aware of?
Within asset level risk, there's idiosyncratic risk. This refers to risks unique to a specific property or deal. It's like encountering a hidden trap in our dungeon, something unexpected that could throw a wrench in your plans. It could be an environmental issue with the property, a major tenant going bankrupt, or unexpected construction delays.
So it's about thorough due diligence and careful analysis of each deal to uncover those potential red flags.
Precisely. Then we have liquidity risk, which we touched upon earlier. Real estate, especially private real estate, is not as easy to sell quickly as stocks or bonds. So if you need access to your capital in a hurry, you might not be able to get it without taking a loss.
It's like entering a part of the dungeon with no quick escape route. You need to be prepared for the long haul. What other risks are there?
We also need to consider credit risk.
Yeah.
This applies when you're investing in debt, like a mortgage on a property. It's the risk that the borrower won't be able to make their payments.
So it's like lending your gold to an adventurer who might not be able to repay you.
Exactly. And then there's replacement cost risk. This is the risk that a newer, better property could come along and make your investment less competitive. For example, if you invest in an older office building and then a brand new state-of-the-art office tower is built down the street, you might find it harder to attract tenants and maintain high rents.
It's like having your favorite weapon become obsolete when a new, more powerful one is discovered. Are there any other risks lurking out there?
Yes, there are a couple more. We have leverage risk. This is related to using debt to finance an investment. Leverage can amplify your returns, but it can also magnify your losses if the investment doesn't perform as expected.
It's a double-edged sword.
Precisely. And finally, there's structural risk, which relates to the legal and financial structure of the investment. This could involve the terms of the partnership agreement, the rights and responsibilities of different parties involved, or the way profits are distributed.
So it's about understanding the rules of the game and making sure they're fair and transparent.
Exactly. Assessing and managing risk is an ongoing process, and it's important to be aware of these different types of risks to make informed decisions and protect your investments.
This has been incredibly insightful. I think our listeners are well equipped to face those real estate investing risks head on now. But before we move on, let's have a quick challenge for our listeners. Take a moment to think about your own risk tolerance and the types of risks you're comfortable taking. Are you more of a cautious investor who prefers stability? Or are you willing to embrace higher risk for the potential of greater rewards? There's no right or wrong answer. It's all about knowing yourself and your investment style. Now let's dive into some key metrics that can help you evaluate investment opportunities effectively. It's like deciphering the map and finding the hidden treasure.
I love that analogy. When it comes to analyzing real estate investments, one of the most commonly used metrics is the equity multiple.
What exactly is an equity multiple?
Think of it as a way to measure how much your initial investment grows over the life of the investment. It's calculated by dividing the total amount of money you receive from the investment by the amount you initially invested. For example, if you invest $100,000 and eventually receive $250,000 back, your equity multiple would be 2.5x.
So it's a simple way to see how much your money has multiplied over time.
Exactly. It gives you a quick snapshot of the overall return on your investment.
Are there any other metrics we should be looking at?
Another important metric is the internal rate of return, or IRR. This one's a bit more complex, but essentially it's the annualized rate of return that takes into account the time value of money.
Can you explain that in simpler terms?
Imagine you have two investment options, one that returns $10,000 in 1 year, and another that returns $12,000 in 2 years. The IRR helps you compare these investments by calculating the effective annual rate of return that equates the present value of the cash flows to your initial investment. It helps you determine which investment is more profitable over time, considering a timing of those cash flows.
So it's not just about the total amount of money you earn, but also when you earn it.
Exactly. The IRR takes into account the time value of money, recognizing that $1 today is worth more than $1 tomorrow due to inflation and the potential to earn interest.
That makes sense. Now, I know there's a lot more to real estate investing than just crunching numbers.
Yeah.
What other factors should we consider?
You're right. Metrics are helpful, but it's important to look at the bigger picture. Consider the risk profile, the manager's experience, the property's location and potential, and all the other factors we've discussed.
It's like considering all the pieces of the puzzle, not just focusing on one piece. What would you say are the most important takeaways for our listeners today?
Real estate investing can be a rewarding journey, but it's crucial to approach it with a solid understanding of the fundamentals. Start by defining your investment goals and risk tolerance. Then explore the different strategies and choose the one that aligns best with your objectives. Remember that due diligence is crucial. Thoroughly research each investment opportunity and don't be afraid to ask questions.
That's excellent advice. And it leads perfectly into our final segment, where we'll talk about resources and next steps for those who are eager to continue learning about real estate investing. But before we do that, let's take a quick break to hear from our sponsor. Welcome back to our deep dive into real estate investing for beginners. We've covered a lot of ground today, from understanding the different strategies and analyzing risks to choosing the right manager and, really deciphering those key metrics. Now, I want to shift gears a little bit and talk about resources and next steps, for those listeners out there who are eager to keep learning and level up their real estate investing game. What advice would you give to our listeners who want to dive deeper into this world?
Well, that's a great question. The world of real estate investing is vast, and there are countless resources available to help you expand your knowledge and expertise. One of the most valuable things you can do is connect with experienced investors and industry professionals.
That finding a mentor or a guide, who can share their wisdom and insights from their own real estate investing journey.
Exactly. Attend industry events, join online forums, and seek out mentors who can offer guidance and support. And of course, there's a wealth of information available online and in books.
So it's about immersing yourself in the world of real estate investing and absorbing as much knowledge as you can.
Precisely. But remember to be discerning about the sources you choose. Not everything you read online is accurate or reliable. Stick to reputable sources and always do your own research to verify the information.
That's crucial. It's like choosing your quests wisely.
Yeah.
Not falling for any traps or scams along the way.
Exactly. And remember, real estate investing is a journey. It's not a sprint. Take your time, educate yourself, and gradually build your knowledge and experience.
It's like leveling up your skills and gaining experience points with each quest you complete.
Precisely. And don't be afraid to seek out expert guidance along the way. A good financial advisor can be an invaluable resource, helping you create a personalized investment strategy that aligns with your goals and risk tolerance.
So it's like having a wise sage by your side, offering advice and support as you navigate the challenges of, the real estate investing world. Well, we've certainly covered a lot of ground in this deep dive. I'm confident that our listeners are feeling more informed and empowered to start their real estate investing journey. Before we wrap up, let's quickly recap the key takeaways. We explored the benefits of real estate investing, including diversification tax advantages and the potential for both steady income and long-term appreciation. We delved into the different strategies from core to opportunistic, each with its own, risk and reward profile. We emphasized the importance of choosing the right manager, someone with a proven track record alignment with your goals, and a transparent fee structure. We also discussed the different types of risks that real estate investors face and how to mitigate those risks through careful planning and due diligence. And finally, we highlighted the importance of continuous learning, connecting with industry experts, and seeking professional guidance when needed.
Those are all excellent points. Remember, knowledge is power, especially in the world of investing. The more you learn, the better equipped you'll be to make informed decisions and achieve your financial goals.
I love that. Knowledge is the key that unlocks the treasure chest of real estate investing success. And speaking of treasures, it's time to reveal the winner of our naming contest. The votes are in, and the official name for this deep dive is Real Estate Investing for Beginners. A deep dive. Congratulations to everyone who participated. We had a lot of great submissions, but this one really captured the spirit of our deep dive. Well, Real Estate Investing for Beginners, a deep dive. It's been an absolute pleasure guiding you through the world of real estate investing. We hope you've gained valuable insights, practical tips, and the confidence to take your first steps on this exciting journey.
Yes, remember, investing is a continuous learning process. Stay curious, keep exploring, and don't be afraid to ask questions. The more you learn, the better equipped you'll be to navigate the real estate market and achieve your financial aspirations. And one final thought before we go. Remember that all investments carry some level of risk. It's crucial to do your research, understand the potential downsides, and never invest more than you can afford to lose. Thank you for joining us on this real estate investing adventure. Until next time, happy investing.
Welcome back to our deep dive into real estate investing for beginners. We've covered a lot of ground today, from understanding the different strategies and analyzing risks to choosing the right manager and deciphering those key metrics. Now, I want to shift gears a little bit and talk about resources and next steps for those listeners out there who are eager to keep learning and level up their real estate investing game. What advice would you give to our listeners who want to dive deeper into this world?
That is a really great question. The world of real estate investing is vast, and there are countless resources available to help expand your knowledge and expertise. One of the most valuable things you can do is connect with other experienced investors and industry professionals.
Yeah, it's like finding a mentor or a guide who can share their wisdom and insights from their own real estate investing journey.
Exactly. Attend industry events, join online forums, seek out mentors who can offer guidance and support. And of course, there's a wealth of information available online and in books.
It's about immersing yourself in that world and absorbing as much knowledge as you can.
Precisely. But remember to be discerning about the sources that you choose. Not everything that you read online is accurate or reliable. Stick to reputable sources. And always do your own research to verify the information.
That's crucial. It's like choosing your quests wisely and not falling for any traps or scams along the way.
Exactly. And remember, real estate investing is a journey. It's not a sprint. Take your time, educate yourself, and gradually build your knowledge and experience.
It's like leveling up your skills and gaining those experience points with each quest you complete.
Precisely. And don't be afraid to seek out expert guidance along the way. A good financial advisor can be an invaluable resource, helping you create a personalized investment strategy that aligns with your goals and risk tolerance.
So it's like having that wise sage by your side, offering advice and support as you navigate the challenges of the real estate investing world. Well, we've certainly covered a lot of ground in this deep dive, and I'm confident that our listeners are feeling more informed and empowered to start their real estate investing journeys. Before we wrap up, let's just quickly recap the key takeaways. We explored the benefits of real estate investing, including diversification, tax advantages, and the potential for both steady income and long-term appreciation. We delved into the different strategies from core to opportunistic, each with its own, risk and reward profile. We emphasized the importance of choosing the right manager, someone with a proven track record, alignment with your goals, and a transparent fee structure. We also discussed the different types of risks that real estate investors face, and how to mitigate those risks through careful planning and due diligence. And finally, we highlighted the importance of continuous learning, connecting with industry experts, and seeking professional guidance when needed.
Those are all excellent points. Remember, knowledge is power, especially in the world of investing. The more you learn, the better equipped you'll be to make informed decisions and achieve those financial goals.
Absolutely. Knowledge is the key that unlocks the treasure chest of real estate investing success. And speaking of treasures, it's time to reveal the winner of our naming contest. The votes are in, and the official name for this deep dive is Unlocking Real Estate, Your Guide to Investing. Congratulations to everyone who participated. We had a lot of great submissions, but this one really captured the spirit of our deep dive. Well, Unlocking Real Estate, Your Guide to Investing. It's been an absolute pleasure guiding you through this world of real estate investing. We hope you've gained, valuable insights, practical tips, and the confidence to take those first steps on this exciting journey.
Yes, remember, investing is a continuous learning process. Stay curious, keep exploring, and don't be afraid to ask questions. The more you learn, the better equipped you'll be to navigate the real estate market and achieve your financial aspirations.
Absolutely. Before we go, just one final thought. Remember that all investments carry some level of risk. It's crucial to do your research, understand those potential downsides, and never invest more than you can afford to lose. Thank you for joining us on this real estate investing adventure. Until next time, happy investing.